Here are 10 of the best stocks to buy for 2023. 2022 was a terrible year for the stock market. The S&P 500 lost 19.4% in those 12 months, even after accounting for dividends, while the tech-heavy Nasdaq Composite lost 33.1%. The reasons behind Wall Street's decline are well known. Many previously high-flying stocks suffered as the risk-off mentality took hold of the markets as a result of rising inflation, skyrocketing interest rates, persistent recession fears, and the Russia-Ukraine war. Thankfully, this opened up a window of opportunity for investors to buy fantastic companies at a discount as the new year approached. The biggest publicly listed corporation in the world, excluding government-backed behemoths like Saudi Aramco, is Apple. Apple shares, like other IT firms, struggled in 2022 as recession worries and rising interest rates alarmed investors in the industry. Apple now prices at 28 times earnings, providing investors with a good entry opportunity into the $2.5 trillion iPhone company after a rare 26.4% decline in 2022. Although its February profits report technically fell short of projections, supply chain bottlenecks rather than demand problems were the primary cause. In actuality, Apple claimed to have more than 2 billion active installed devices and $20 billion in high-margin services revenue. Apple stock is recovering from its 2022 problems. As of April 24, 2023, shares were up 27.4%. While large, well-known corporations like Apple can provide investors with some stability, smaller businesses have more room for growth and can strengthen portfolios. Let's compare Apple to the quickly growing coffee business Dutch Brothers, which is approximately 0.2% the size of Apple yet is worth $5 billion. Revenue will increase by 48.4% in 2022, expanding like a plant. With its origins on the West Coast, Dutch Brothers now has 671 sites in 14 states, virtually all of them are in the West and Southwest. Its drive-through locations are very inexpensive to build because to their tiny size, which enables quicker development. The statistics support this. In 2022, Dutch Brothers added 133 new locations, which translates to a location increase of 25%. Through April 24, shares have increased by 11.5%. The following bank is Citigroup, a $90 billion international institution with divisions for retail and investment banking. Citigroup provides two things to investors. First of all, at a time of increasing rates and strong inflation, it offers owners a decent cushion with a respectable 4.2% dividend yield. Importantly, that dividend is long-term sustainable, with Citigroup financing its payouts with less than 30% of earnings. In addition to paying a substantial dividend, Citigroup seems to be a bargain company at the present price, selling for only 0.51 times book value and 8 times projected profits. In the first quarter of 2022, renowned investor and financial expert Warren Buffett started purchasing Citigroup shares. As a result, Berkshire Hathaway Incorporated now has an approximately $2.5 billion holding in the business. As of April 24, 2023, shares of Citigroup have increased by 9.5%. Amazon, a major online retailer, was also included as one of the top 10 stocks to purchase in 2023. The e-commerce behemoth had a terrible 2022, during which time the value of its shares dropped by 50%. Cost growth, a tight labor market, supply chain issues, and declining consumer confidence were the main offenders. Nevertheless, the market was far too quick to write off Amazon, whose crowning achievement is its sizable, rapidly expanding, and wildly successful cloud services division, Amazon Web Services. Over $85 billion in revenue is generated annually by AWS. Given that Microsoft Corporation MSFT, a competitor in the cloud services market, trades for approximately 10 times revenues, valuing AWS at the same multiple would put its worth at $850 billion. Investors may acquire the remainder of Amazon's enormous businesses, which reported 2022 revenues of $434 billion, for around $150 billion at the company's current $1 trillion value. With shares up 26.4% through April 24 so far in 2023, Amazon has shown to be a wise investment. The management team of a firm is among the most crucial factors to take into account when choosing stocks to purchase and keep for the long term. And Disney has it in spades with the recent return of long-standing CEO Bob Iger. Before handing up the reins to Bob Chapek in February 2020, Iger, who is regarded as one of the greatest CEOs this side of the millennium, presided over a string of enormously profitable acquisitions, including Pixar, Marvel Entertainment, and Lucasfilm. Disney exceeded expectations for both profits and sales in its February earnings release, the first since Iger's comeback. While revenue from its theme parks increased 21% in the quarter following a price increase for the streaming service Disney+, subscriber losses were less severe than anticipated. This stock is outperforming the S&P so far in 2023, with shares up 14.7% this year through April 24th. Despite profits per share in 2022 of $4.13, which is more than any year between 2018 and 2020, PayPal, a tried-and-true financial business, is oddly selling for less than its pandemic lows from 2020. Due to a deteriorating macroeconomic climate and the termination of its profitable partnership with eBay Incorporated, (eBay), the company's shares took a severe beating in 2022, falling 62%. Despite a 5-year average of 36.5, shares now trade at around 15 times anticipated profits in 2023. PayPal's lowest price earnings (PE) ratio between 2015 and 2021 was 20.3. Applying that cautious multiple to the $4.88 average predicted 2023 profits results in an early 2024 price of $99.06 per share, representing an increase of more than 33% from the closing on April 24th. Venmo's footprint in physical stores may increase as a result of recently announced agreements with Apple Pay to take Venmo and PayPal branded cards. Amazon also accepts Venmo, providing PayPal access to Amazon's sizable online marketplace. PayPal stock has up 4.3% year-to-date as of April 24th. EOG is a U.S. oil and gas company coming off a stellar 2022 in which shares achieved a total return of 56.3%. It was a return choice from the best stocks to buy list from the previous year. Despite this, shares are still valued as a value stock, trading at around 9.5 times projected earnings. Growth will undoubtedly slow down in 2023 since the hot energy market is unlikely to soar like it did in the year of 2022, which was afflicted by inflation and conflict, but investors shouldn't discount the importance of having an inflation hedge in their portfolios. EOG has considerable credibility with income investors because to its 2.8% dividend yield and remarkably low payout ratio of around 23%. EOG shares have declined as inflation worries have diminished in the first months of 2023, making it the company on the list with the poorest performance to date. Through April 24th, the stock has experienced a year-to-date loss of 5.9%. The next company on the list is Taiwan Semiconductor Manufacturing, a $500 billion company that dominates high-level foundries manufacturing cutting-edge semiconductors. TSM has a substantial market share for chips 7 nanometers and smaller in the semiconductor sector. Foundries are businesses that produce chips for other businesses. One of TSM's largest clients is Apple, which has begun to move its supply chain away from China. Both the top and bottom lines of the company's fourth quarter results, which saw a 43% increase in sales and a 78% increase in profits per share, exceeded expectations. TSM is, incidentally, yet another Buffett position and trades at only 14 times earnings while paying a 2.1% dividend. Through April 24th, its shares had increased 14.2%, hammering the market in the first quarter of 2023. The $100 billion beverage juggernaut Diageo is the last to speak. Diageo, a consumer defensive company, should be able to withstand a challenging macroeconomic climate given that alcohol is often recession-resistant. Alcohol customers, like those who use tobacco, have a good amount of brand loyalty, and the corporation has an excellent position in the market because to its portfolio of premium brands, which includes Johnnie Walker, Guinness, Tanqueray, Don Julio, Smirnoff, Baileys, Ciroc, and Bull Light. Despite net sales increasing by 21.4% in the fiscal year 2022, the stock decreased by 17.4% last year along with the overall market. That's mostly because of its British roots and a challenging year for the pound sterling. That downturn can't continue forever, and shares are now trading at a discount to their 5-year average future PE of 24.4, or approximately 21 times ahead earnings. Through April 24th, the defensive DEO has increased by 6.9%.